Apple's share price has dropped 10%. You know what that means? We have to sell.
Buy. What?
What? Well, obviously, like, not sell, but it's not a discount yet for us to be buying. Well, yeah, it's not cheap by conventional standards, but it's Apple. We can't use the same valuation metrics that we use on other companies. Conventional standards are all that matter. We've got to be consistent when valuing earnings. We can't make an exception for Apple. This is a growth stock. We must accept a higher valuation. Come on, past success is not indicative of future success. We must accept that Apple is now a value stock, not a growth stock. Its growth is mostly done. I was going to say there's more growth to come. Apple is the only company in the S&P 500 that can be depended on to deliver on its expected growth. Okay, we need to test it. We just agree? Great minds. Hey guys, welcome to 2 Minute Tuesday. I feel like I'm always looking for an opportunity to buy Apple, and basically every time the price drops I have this exact conversation. The reason I want to own Apple is mainly because of their products. I own an iPhone, I own this MacBook, and I own an Apple Watch and an iPad. Please do not rob me. I've got most of those items secondhand, but I buy them not because I'm just some sort of crazy Apple fan, but because Apple products genuinely are the best thing for me. And I don't actually consider them to be at a premium. I actually believe that the higher price you pay is for better quality and better services. Anyway, I'm going to super quickly punch the numbers in to Stock MVP, which is the site I use to get a discounted cash flow model. Stock MVP is a fantastic site for insider buying and data going back 10 years. So if you want a subscription, please use my code HJGWhite for a 10% discount. So on Stock MVP, I typically don't adjust the long-term growth rate and the discounted growth rate just so that they are consistent between all the stocks I'm valuing. What I play around with is the EBITDA growth rate and the depreciation and amortization growth rate and the capex growth rate. That's just basically the earnings and the depreciation of the assets and also the rise in capital expenditure as you expect over time. For Apple, the stock has grown at an incredible 50% over the last 5 years. And so a discounted version would be 25% on each. And I'm just going to do 25% across the board, which will create some buffer for me. However, when I do this, it still comes out as 17% overvalued, which is just not what I'm looking for. I'm at least looking for it to be undervalued. Some stocks, when you look at Crocs, I have put even less growth in there, 20%, 20%, 20%, even though you can expect a higher growth because they grew 1,700% over the last 5 years. So that Crocs is undervalued by 175%. So that is what I'm looking for, extremely undervalued businesses, and Apple just isn't there yet. However, I would need to set the growth expectation to something like 40% in order to get the company to come up as undervalued, which for me just isn't enough margin of safety. For the record, I think Apple is an amazing stock, and for those holding for 10 years, I think this is a brilliant asset to hold. I would personally prefer to hold the index fund, the S&P 500, just to have some more businesses that potentially have more growth in and just have more diversification. But absolutely, Apple is a fantastic stock to hold over a long time period. It's just not a value play right now. Guys and gals, I truly hope you enjoyed this video as much as I enjoyed making it. If you want me to do another 2 Minute Tuesday, please hit the like, subscribe and notification bell, and let me know in the comment section what stock I should do a valuation on next week. Right, thank you very much. Goodbye.